Okay, let's unpack this. What does it truly take to build an enduring company, one that not only survives, but thrives through all sorts of market turbulence?
Right. Not just survive, but actually get stronger.
Exactly. We're talking about an organization that defines its own path to greatness and really sticks to it, come what may. Today, we're diving into the Markel Group's incredibly insightful 2023 letter to business partners. It's just a rich source of insights into long-term vision, resilience, and, well, how one company pursues greatness, even when things get tough.
Yeah, and what's fascinating here is how Markle lays out this almost universal definition of success, but then couples it with a uniquely structured approach to actually achieve it. Our mission today really is to dissect that structure and see how it all played out in 2023. This letter, it was comprehensive.
Yeah.
It laid bare both their, significant successes and some quite candid struggles. So we'll be extracting their core philosophy, highlighting the triumphs, openly addressing the admitted missteps, and revealing those forward-looking strategies that you can definitely apply, I think, to your own endeavors.
Definitely. So if we want to understand Markel, we really have to start at the foundation, right? The Markel-style creed.
That's the bedrock.
It is. This document was written way back in 1986, actually right around their IPO, their initial public offering, when they first became publicly traded. And it kicks off with this powerful declaration. The Markel Group has a commitment to success. Simple, but profound.
But what does success mean to them? That's the key.
Exactly. They clearly define building one of the world's great companies through three essential pillars. It's not vague. First, great companies deliver first-rate products and services. Seems obvious, maybe?
Well, obvious but hard to execute consistently.
True. But for Markel, this isn't just about selling something once. It's about creating deep customer loyalty, generating referrals, and ultimately building a self-sustaining cycle of business. Quality isn't just a buzzword. It's the engine of repeat business for them.
Makes sense.
Second, great companies provide meaningful careers. The Markel style explicitly promises an atmosphere where people can reach their personal potential. And you really see the proof in the numbers. They started with, what, roughly 300 employees back in '86?
Something like that, yeah.
And today, they've grown to over 20,000 people. 20,000, all continuously learning, creating, working for customers and each other. That's a remarkable testament to their approach, isn't it?
It absolutely is. That kind of growth sustained over decades while trying to maintain a specific culture, that's a real challenge.
For sure. And the third pillar, great companies attract and maintain long-term, committed, and crucially high-quality shareholders. They achieve this by consistently earning excellent and sustainable returns on the capital needed to run the business.
So it's not just about growth, it's about profitable growth that rewards the people who own the company long term.
Precisely. It's a very clear, very logical, and, dare I say, almost timeless framework for success.
That commitment to success, having it codified like that, written down back in '86, that's so powerful. It's definitely not just corporate speak gathering dust on a shelf.
Right. It feels active.
It does. It becomes their North Star, really informing every decision, every adaptation, every tough choice they have to make. It's genuinely a universal definition that could apply across almost any industry. But it makes me wonder, how do you think having such a foundational definition written down explicitly like that versus just being an unwritten cultural norm, how does that truly impact a company's ability to navigate constant change?
Oh, that's a great question. Because I think the clarity just removes so much ambiguity. When it's on paper, it provides a consistent lens to look through. Even when the market is going absolutely sideways or there's some new crisis, everyone knows the fundamental goals.
Yeah, less room for interpretation, maybe.
Right. It prevents that sort of mission creep and keeps everyone aligned on what success actually looks like for them, no matter what the external noise is telling them.
Okay, that makes sense. It's a shared reference point.
Exactly. And speaking of navigating change, beyond their foundational creed, Markel's structure itself is where things become, I think, truly fascinating. They're definitely not a one-trick pony. They've consciously designed this multifaceted system, their three-engine architecture, which they believe creates superior, self-reinforcing resilience and sustainability.
3 engines, okay.
Yeah, and it's a system that's evolved over decades, right? Each engine adding another layer of strength. Engine 1, that's the original foundation. Their insurance business started way, way back in 1930.
The core.
The core. Then, after their IPO in 1986, they put extra emphasis on their investment operations. That's Engine 2. And this wasn't just parking insurance float in boring, safe bonds. They intentionally included substantial public equities to achieve better returns than most insurers typically target. A bit more aggressive, perhaps?
Huh. Taking calculated risks for higher reward over the long term.
Precisely. And finally, starting in 2005 with the purchase of AMF Bakery Systems, I believe.
Yeah, that was the first big one.
They began acquiring majority stakes in non-insurance businesses, creating Engine 3, Markel Ventures. So insurance, investments, and ventures.
Okay, so that's a fascinating evolution. Insurance, then adding a more active investment arm, then adding completely separate operating businesses. But what's the real strategic genius behind adding that third engine, moving beyond just insurance and investments? What problem does that solve? Because, it sounds like it could potentially spread resources thin, couldn't it?
That's absolutely the potential pitfall, isn't it? Many companies do struggle with diversification. They lose focus. Diversification, they sometimes call it.
Right, diversification. So how does Markel avoid that? I think the core insight here, and this is really key, is that true resilience comes not just from diversifying your products, but from diversifying your fundamental profit-generating models.
Ah, okay. Different ways of making money.
Exactly. This three-engine architecture is profoundly about adaptation and volatility absorption. It allows the company to make forward progress even if one or maybe even two engines aren't firing on all cylinders in any given year.
Like internal shock absorbers.
Precisely. Internal shock absorbers for external market turbulence. It bolsters their long-term perspective and significantly reduces dependency on any single business or market cycle. You could almost see it as a strategic hedge against an uncertain future, allowing them to continually reinvest even when one area faces, serious headwinds.
It's almost like having three different ways to earn a living, If
Okay.
one industry hits a snag, the others can hopefully carry the weight.
That's a good analogy.
So now let's look at how this three-engine system actually performed in 2023, because the year was, well, a bit of a mixed bag as they described it.
Yeah, they were pretty upfront about that.
They were. Markel reported excellent results in two of their engines, but, candidly, fell short of their goals in the third. It's actually a perfect illustration of the system's resilience at work, you could argue.
So the diversification paid off in a way.
It seems so. Let's dive into the Markel Ventures engine first. They called it a truly spectacular year.
Okay, strong words.
Yeah, and the financial snapshot is pretty impressive. Since its launch back in 2005, Markel has cumulatively invested about $3.7 billion in acquisitions for ventures. From those operations, they've built up $1.9 billion in cash and dividends that have flowed back to the parent company.
So pretty good return already just on the cash back.
Definitely. And today, they have approximately $1.7 billion still on the line, so to speak, for a set of businesses that generated $628 million in EBITDA in 2023.
EBITDA earnings before interest, taxes, depreciation, and amortization, a common proxy for cash flow.
Right, a quick measure of operating cash flow, and that was on $5 billion in revenues in 2023. So significant operations.
Those are substantial businesses.
They really are. And their long-term approach here is fascinating and, frankly, quite countercultural to a lot of the private equity world.
How's it?
Well, they use minimal debt. That removes a huge pressure point from business decisions, right? And they intend to hold businesses indefinitely, forever potentially, without ever planning to re-auction them off.
So no 5 to 7 year flip cycle.
None of that. It fosters this unique culture where leaders can truly flourish, as they put it. Their quote is great. Why operate in a debt-fueled and short-term pressure cooker when you don't have to?
Makes sense if you have the capital structure to support it.
Exactly. They did note no new platform acquisitions in 2023, citing high prices in the market, but they did make additions to existing businesses like VSC Fire and Security, Costa, and Metromont. Bolt-ons, essentially.
Okay, so Ventures had a great year. What about Engine 2 investments?
Right. Let's turn to the investment engine. Performance there was described more soberly as designed, but still very strong.
As designed, okay.
It delivered an impressive 64% increase in recurring interest and dividend income, reaching $735 million in 2023. That's a big jump.
Wow, 64% increase in income. That's substantial.
It is. And their equity portfolio alone achieved a total return of 21.6% during the year. Pretty solid market year, but still a good result.
Definitely keeping pace or better.
They attribute this success to their unique, long-term, four-part discipline for equity investing. It's worth listing these. First, they invest in good businesses with good returns on capital. Second, they look for talented and integral management teams, people they trust.
The who matters as much as the what.
Absolutely. Third, they seek businesses with reinvestment opportunities or strong capital discipline. And fourth, they aim to acquire these stakes at fair prices. Doesn't sound revolutionary? Maybe, but the discipline is key.
Consistency over chasing fads.
Exactly. And there's also this powerful tax efficiency aspect to their strategy that often gets overlooked. As of the end of 2023, they had an unrealized gain of over $6 billion in their equity investment portfolio.
$6 billion. Wow.
Yeah, so at the current U.S. tax rate, this effectively means they have $1.3 billion of zero-cost capital from a deferred tax liability.
Okay, explain that a bit more.
Yeah.
Zero cost capital.
Right, it's not money they've saved exactly, but it's money they would owe in taxes if they sold those stocks and realized the gains. But because they don't sell, they get to keep that $1.3 billion working for them, earning returns, until they actually realize the gains, potentially years or decades down the line.
Ah, okay. So it's like an interest-free loan from the government, in a sense, generated by their own investment success and patience.
That's a good way to put it. It's a powerful, patient capital advantage because they avoid frequent trading. Their philosophy is pretty clear. If it's all the same to you, I'd prefer to wait a while.
So why does this long-term, tax-efficient approach give them such a huge economic advantage over, say, traders or funds with higher turnover? It sounds simple because just don't sell, but there must be more to it, right?
Yeah, absolutely. Sounds almost too easy, like just sitting there makes you money.
Right.
But there's a deeper layer.
Exactly. I think the surprising insight here isn't just about saving on the tax bill itself, although that's significant. It's about the behavioral discipline that a hold forever, or at least hold for a very long time, mentality enforces.
Okay, the psychology of it.
Precisely. It eliminates the temptation, or at least reduces it, to constantly chase fleeting market trends or react to short-term noise. It frees up capital from those frictional transaction costs, brokerage fees, bid-ask spreads, taxes, and critically, it allows compound interest to just work its magic over decades, relatively undisturbed.
What compounding run?
Let it run. So this isn't just about tax law, it's really about temperament. And this approach, it creates a compounding effect not just on their financial returns, but also, I think, by reinforcing their overall long-term focus across the entire Markel Group's culture and decision-making. It's a subtle but pretty profound advantage.
That makes a lot of sense. Temperament over timing. Okay, so ventures, spectacular investments as designed, strong returns, tax efficient. However, not every engine fired on all cylinders, as we said. The insurance engine, engine one, the original business, well, it fell short of its goals in 2023.
Okay, the core business faced some issues.
It did. They reported a 98% combined ratio. Now, just explain that quickly. It means for every dollar in premiums they collected, 98 cents went towards paying claims and covering operating expenses.
So still profitable on the underwriting side, but barely, just 2 cents on the dollar.
Exactly. Still profitable, which is good, but it just nudged past their aggressive internal target of being comfortably below 100%. They're very, very upfront about this in the letter. No sugarcoating.
Transparency is good. What were the challenges?
They grouped them into a few categories. One was what they called unforced errors, acknowledging mistakes.
Ooh, interesting phrasing.
Yeah. For instance, their initial foray into something called collateralized intellectual property insurance, basically insuring things like patents and trademarks, using them as collateral for loans. Well, they said it did not go well.
It sounds complex.
Very. They cited product design issues and a mismatch of risks they took on. In response, they've already altered the terms and conditions and changed management teams involved. So, quick adaptation, but an admitted stumble.
Learning the hard way, perhaps.
Seems like it. They also faced significant losses from natural catastrophes, like the devastating Hawaii wildfires. That led them to proactively reduce their exposures in certain high-risk areas and increase rates. And this points to a broader societal issue. They mention the rising costs and sometimes reduced availability of insurance in places like California and Florida due to climate change and other factors.
Yeah, that's a huge challenge for the whole industry and for society, really.
Definitely. Inflation also played a role.
Yeah.
And they make an interesting distinction here. They talk about vanilla inflation. You know, the general price increases for materials, labor, repairs, things that impact claims costs directly.
That's your stuff.
Standard stuff. But then they highlight social inflation.
The legal environment.
Exactly. This refers to the spikes in legal costs, larger jury awards, and the impact of litigation financing. They even draw parallels to the asbestos crisis back in the 1970s and 80s. So it's not just the price of steel going up for a car repair, but the legal bills attached to claims potentially becoming truly epic.
That's a much trickier kind of inflation to predict and manage for an insurer.
For sure. Markel's response. They say it includes increasing discipline in underwriting, lowering policy limits in some areas, tightening terms and conditions, charging more where appropriate, and significantly increasing their data intensity to try and adapt more quickly to these trends.
Lots of levers to pull there.
Yeah.
What's fascinating here, though, is the humility. Admitting unforced errors and talking openly about learning from these, frankly, expensive experiments, it really powerfully reinforces their stated belief that they must embrace change and also never forget the basics of insurance to stay relevant.
Constant learning.
But it also makes you wonder, with such a clear Markel style and all this discipline, how do these unforced errors still creep in? What does that tell us about even the best-run, most disciplined companies?
That's a really good point.
Yeah.
I guess it tells us that even with the best intentions and the clearest possible vision, execution is just hard.
Yeah.
And the market, or the world, can always throw you a curveball you didn't fully anticipate. It really shows the importance of that learning culture you just mentioned. You can have a great plan, but you also need to be able to react and adjust when things don't go according to plan.
Adaptability is key, even within a strong framework.
Exactly. And despite those hurdles, the insurance engine did have some notable bright spots in 2023. It wasn't all negative. Their international operations, led by Simon Wilson, apparently produced spectacular results. Their word, again, with double-digit profitability and growth. So successfully expanding Markel's geographic reach and product offerings outside the U.S. paid off.
Good diversification within the insurance engine itself.
Right. They also saw strong profitability in specific pockets of their specialty operations in the U.S. Things like property and land marine, surety bonds, some personal lines, environmental insurance, management liability, niche areas where they have deep expertise.
Playing to their strength.
Seems like it. Another success story they highlighted was Nephila. Now, Nephila is an insurance-linked securities manager they acquired a few years back. Markel's strategy to shift some of their larger property catastrophe exposures off Markel's balance sheet and onto Nephila's platform, which works with different third-party capital providers, well, that proved successful in 2023.
So using Nephila to manage their own peak risks?
Precisely. Nephila produced $22 million in pre-tax earnings for Markel in 2023. That's a significant turnaround from a $16 million loss in 2022.
Okay, so that validates the strategy.
It does. It caps Markel's own downside risk from huge catastrophes and validates their original, maybe somewhat controversial, thesis for acquiring Nephila in the first place.
Interesting synergy there.
Yeah. And they also mentioned Matt Freeman's team at State National, another specialized part of their insurance operations, delivered excellent results with plans for global expansion in 2024. So definitely a mixed bag in insurance, but with clear areas of strength and adaptation.
Okay, so you have ventures doing great, investments doing well, insurance having challenges, but also bright spots and making adjustments.
Right. So with all this capital being generated by these three engines, some more than others in any given year, the next crucial step, and maybe the most important one, is how it gets allocated. Where does the money go?
The capital allocation question?
Yeah.
Always key.
Always key. Markel believes their multi-engine system provides a fundamental advantage here. The ability to rationally reinvest capital wherever it will earn the best possible return across their entire system.
Flexibility.
Huge flexibility.
Yeah.
Use this great analogy in the letter to think about the hit Broadway show Hamilton.
Okay, Hamilton.
The early investors earn fantastic returns, right?
Yeah.
Just phenomenal. Great. Congratulations to them. But the challenge for those individual investors is finding where to reinvest that money now to get anything close to those same rates of return. It's tough.
Yeah, replicating huge success is hard.
Very hard. For Markel, however, this ability to continuously reinvest the profits generated by their engines is a fundamental and ongoing opportunity built into their structure. Their corporate structure allows them to reinvest those after-tax earnings from the engines without incurring an additional layer of taxation, unlike if they just paid everything out as dividends to shareholders who would then be taxed again.
The tax efficiency of reinvesting internally.
Exactly. So they have basically four choices for allocating that capital.
What?
Fund growth in their existing businesses, insurance, ventures, whatever needs it.
Makes sense. Feed the winners.
2, acquire new businesses, either bolt-ons for ventures or maybe even a new platform if the price is right. 3, purchase publicly traded equities or fixed income securities through their investment engine.
Add to engine 2.
Or 4, repurchase Markel Group common stock if they think it's trading below its intrinsic value.
Buying back their own shares.
Right. And in 2023, they were active on those last two fronts. They repurchased $445 million of their own common stock, noting a growing appetite because they perceived a discount to intrinsic value.
So they thought their stock was cheap.
Pretty clearly, yes. And they also made $340 million net in public equity purchases, meaning they still found value in the stock market, even in what they call a white-hot market environment overall.
Still finding opportunities based on their discipline, that's a huge amount of flexibility they have. But how do they actually decide where to put that capital? And crucially, especially for the share buybacks, how do they value themselves against the daily noise and swings of the stock market? This really begs the question, how do they figure out their own company's worth?
Yeah, it must be tempting just to look at the stock price like everyone else, right?
Yeah.
But they seem to use an internal compass, avoiding the noise.
Precisely. And they're quite transparent about it. Markel uses this consistent method they've called orange and blue capital ever since their 1986 IPO.
Orange and blue.
Yeah, it's their framework. This method guides their capital allocation decisions, especially, as you said, for share repurchases. So the orange component of value is essentially their net investments per share. How do they calculate that? They take all their investments, stocks, bonds, cash, subtract all debt, and then divide that number by the total shares outstanding.
Okay, so basically the investment assets minus debt on a per-share basis.
Exactly. And the big assumption baked in here, which their decades of history generally support, is that if their insurance operations maintain that combined ratio under 100%, meaning they're profitable or break even on underwriting and don't shrink significantly, then all the returns generated from that total investment portfolio ultimately accrue to the shareholders. The insurance business pays for itself, and the investment profit is for the owners.
Got it. That's the orange part. What's blue?
Then there's the blue component. This focuses on the other sources of earnings, the normalized non-investment operating income.
So the underwriting profit from insurance, the earnings from Markel Ventures.
Exactly. Underwriting any non-underwriting insurance operations and the earnings from the Markel Ventures businesses, all after subtracting corporate expenses and taxes. They take this normalized operating income figure, apply a relatively conservative, consistent multiple to, they don't say exactly what, but it's kept consistent, and then divide that result by the shares outstanding.
So a value for the investments and a value for the operating businesses.
You got it. Adding these orange and blue numbers together gives them their internal sense of intrinsic value per share. And they point out that this calculated intrinsic value has compounded at a double-digit rate over many decades.
Impressive compounding.
Very. And this calculation directly guides their capital allocation, particularly telling them when the market price for Markel Group shares might be trading at a substantial discount to what they think the business is actually worth. It's their way of cutting through the market's daily chatter and making rational decisions.
A disciplined internal yardstick. Makes sense. So as we sort of bring our deep dive here to a close, what really stands out to you from this 2023 letter and their whole approach? For me, it's that powerful combination of, first, a clear, pretty much unchanging definition of success, the Markel style. Second, that adaptable multi-engine system, giving them resilience. And third, just a relentless, almost stubborn long-term focus, even when they're candidly admitting mistakes along the way.
Yeah, I agree with all that.
Markel's commitment to knowledge of the path,
Yeah.
and understanding where they're trying to go, combined with just putting one foot in front of the other, as they've done since 1930, it really demonstrates the incredible value of persistence, rationality, and letting compounding work over the very long haul.
Absolutely. And maybe looking beyond Markel's specific case, if we connect this to the bigger picture, their journey is a great reminder for all of us, I think. It shows that true resilience isn't really about avoiding challenges or downturns, because you can't, right?
Right, they're inevitable.
They are. It's about building systems and, maybe more importantly, a culture that can absorb volatility, learn from the errors, because there will be errors, and consistently apply a long-term mindset. It really encourages you, our listener, to maybe ask yourself, what engines are you building in your own life or your own business to ensure that the things that, must happen will, as they might say? How do you ensure progress even when you face unexpected headwinds?
That's a powerful question. What are your engines?
Yeah. How are you prioritizing persistence, rationality, and that incredible power of compounding in your own decisions? Not just for today or this quarter, but thinking truly long-term for decades to come. It's a powerful lens, I think, to look at everything from your career choices to how you manage your investments.
A great thought to end on, building your own resilient engines for the long haul.